So friends are telling me that their financial advisors are advising them to move out of one stock and get into another. Warren Buffett says, put your money in a low-cost index fund and leave it there. Why do you think it is that the Oracle of Omaha suggests the individual investor play it safe, relatively speaking, with an index fund? It's because Warren Buffett understands the illusion of validity paradox. Stay tuned. Hi everyone, I'm Don Owen, and this is DFY Informed. Thank you for watching. Hit like if you like, dislike if you don't, subscribe if you're interested in seeing more. Now, let's get started. So friends are telling me that their financial advisors are advising them to move out of one stock and get into another stock for better performance. These are stocks my friends have held in their portfolios for quite a while, and that pay very nice dividends, especially if one considers the return percentage on the original amount invested. But you can make more money on company fill in the blank, advises one Edward D. Jones financial planner. I can move it for you, he says, very easily. And then you find out how much of your gains he's going to take as a fee for doing so. In the 1973 book, A Random Walk Down Wall Street, Princeton University professor and former 28-year director of the Vanguard Group, Burton Malkiel, presents the central idea that a company's stock price reflects all available knowledge about the value of the company and the best predictions about the future of the stock. The stock market is mostly a supply and demand driven market. When there's a stock sold on the open market, there's generally a buyer. A buyer buys because he or she thinks the stock price is undervalued and will thus increase in the future. A seller sells because he or she thinks the stock is close to fully valued and that a better return on investment can be made in some other position. Of course, if buyers outnumber sellers at a given price, the price of the stock will go up. Likewise, if the number of sellers exceed the number of buyers at a given price, the stock price will drop. It's Econ 101. So I'm going to ignore the case of the individual investor, or the so-called retail investor today. Instead, I want to focus solely on the professional financial manager in this video. This is a person who, because of his or her education and experience, is supposed to know more than the retail investor. So I want us to consider the playing field for professionals for just a second. If Malkiel was correct, and I believe that he was, then all information and best known predictions about the future are already reflected in a stock's current price. That means that if a money manager is trying to get you to sell one stock and move into another one, he's suggesting that either one, he knows something that all other professional money managers don't, or two, he thinks they're all incorrectly interpreting data that they have available to all of them. See the dilemma? A UC Berkeley finance professor, Terry Odian, and his colleague Brad Barker published a paper in the Journal of Finance in 2000 titled, "Trading is Hazardous for Your Wealth." In that paper, they showed that on average, the most active traders had the poorest results, while the traders who traded the least had the highest returns. I'm going to introduce another concept here because it's relevant to this discussion. Daniel Kahneman, a 2002 Nobel laureate, defines evidence of skill as passing the test of persistent achievement. If you think about it, we apply this test of persistent achievement to a number of skilled individuals. Michael Jordan, Tiger Woods, Peyton Manning, Roger Federer, Steffi Graf, Jackie Joyner-Kersee, the list could go on and on. These athletes pass the test of persistent and consistent achievement. They perform or did perform better than their peers over the course of their careers. Kahneman suggests that fund managers fail this test. Thus, their performance can't be attributed to skill, but simply to luck. Look at a quote by Kahneman. It says, "Mutual funds are run by highly experienced professionals who buy and sell stocks to achieve the best possible returns for clients. Nonetheless, the evidence for more than 50 years of research is conclusive. For a large majority of fund managers, the selection of stocks is more akin to rolling dice than it is to playing poker. Typically, at least 2 out of every 3 mutual funds underperform the overall market in any given year." Folks, this is anything but persistent achievement. Consider Jim Cramer for a moment. He's the entertaining, bombastic analyst on CNBC. Even Jim Cramer's own hedge fund, as of 2016, had failed to match the performance of the S&P index since the fund's inception in 2001. If this is true, and it's on the chart on the screen, then why on earth would anyone listen to Cramer's advice for what stocks to buy and sell? Granted, he's fun to watch, rant and rave, and push his various sound effects buttons, but I have personally never made an investment decision based on anything he said. A number of years ago, Kahneman was invited to speak at a group of investment advisors in a firm with a very wealthy clientele. As preparation, he asked for data regarding investment outcomes for 25 anonymous wealth advisors. I'll spare you the details. If you're interested, you can read Kahneman's own words about it on page 215 in his book, Thinking Fast and Slow. But to summarize, Kahneman found from the data the same thing Odeon had found before. There was no correlation between investment performance and supposed skill. Not a low correlation, but zero correlation. In fact, Kahneman states, the results resembled what you would expect from a dice rolling game, not a game of skill. These results were presented to the executives of the firm, and they couldn't really argue the results. They, in fact, had provided the data and were all skilled enough in higher level math and statistical analysis to understand the implications. The executives were essentially rewarding wealth advisors with huge bonuses for being lucky. However, when presented these results, the executives attempted to justify the huge salaries and bonuses. Kahneman tells us that cognitive illusions are harder to overcome than even illusions we experience visually. Ideas or facts that challenge self-esteem or self-importance are practically impossible for an individual to accept. The mind simply refuses to digest them. So rather than acknowledge the overwhelming evidence that points to the disassociation between skill and performance, many, if not all, wealth advisors still live in this illusion of validity or illusion of skill. After all, they're paid exorbitant salaries, and to acknowledge that a dart-throwing monkey could achieve better portfolio returns than them, well, you can see how this could be a problem. Look, I'm not here to crap on the financial advisor profession. I think the profession provides tremendous value in providing insight to retirement planning, overall investment strategy, and risk management. But I don't think clients should be listening to individual stock picking advice from them. Over 50 years of data supports the hypothesis that the average financial advisor is no better at picking stocks than are you, or a dart-throwing monkey. But as always, I encourage you to decide for yourself, informed. Have a great week.